Welcome to our new podcast series. I'm Nicola Hughes, a senior associate in the restructuring team, and I'm joined today by Sheena Frazer, a partner in our team. While the relatively new restructuring plan is being well used, we still expect the pre-pack sale to maintain its status as a streamlined and expedient rescue tool. And in this first series, we cover a range of thorny issues which might impact the timeline or the complexity of a pre-pack sale. Today's topic is the National Security and Investment Act 2021, or commonly referred to as NS&I, and Sheena will explain its relevance in insolvency sales. Sheena, the NS&I came into force on the 4th of January 2022, with its purpose being to protect the UK national security. The Act focuses on certain sensitive sectors, which include critical suppliers to government, defence, energy, transport. Please, could you explain a little bit about the Act relevant to insolvency sales?
Yes, sure. Thanks, Nicola. The NS&I Act provides a screening regime to protect national security by introducing notification procedures for qualifying acquisitions. Now, a qualifying acquisition is one where there is an acquisition of a right or interest in a qualifying asset or a qualifying entity. The definition of qualifying asset is broad and captures land, tangible movable property, and intangible assets like, say, intellectual property. Qualifying entities cover companies, limited liability partnerships, and even trusts. There is also other criteria for being a qualifying acquisition. For example, the target entity or asset being acquired must be from or in or have a connection to the UK. The level of control being acquired must pass certain thresholds. For example, a purchaser's stake or voting rights in a qualifying entity will exceed as a result of the transaction from its current shareholding to 25%, 50%, or 75%. And also, the acquisition must not have completed before 12th November 2020. In the context of insolvency sales, whilst the appointment of administrators over a qualifying entity does not require notification, the subsequent realisation of assets, so the subsequent insolvency sale, including for shares by a company in administration, may require notification.
Thanks, Sheena. And so where do the sensitive sectors fit in?
So as mentioned, the NS&I Act introduces a notification regime for qualifying acquisitions. There exists a mandatory notification regime and a voluntary notification regime. Mandatory notification is required for acquisitions of qualifying entities only, so share sales essentially, where the target entity operates in one of the 17 sectors, some of which you already mentioned. It's worthwhile noting that the target does not necessarily have to be UK-based, but it must carry out certain activities in the UK within the relevant sector. Additionally, the purchaser must be acquiring or increasing its stake or voting rights over the prescribed limits I mentioned. Therefore, in the case of insolvency sales, approval of a sale would be needed before an administrator completed a sale. Any sale without approval is void, and civil and criminal penalties can also be imposed. In contrast, voluntary notification, as the name suggests, is not astringent and applies to asset sales as well as share sales, where the target entity operates outside of the 17 sectors. For such sales, there is no legal requirement to notify qualifying acquisitions, and you can complete a sale without receiving any approval. However, if the parties believe a sale is a qualifying acquisition and therefore potentially captured by the notification regime, it may be prudent to obtain approval prior to completion, as the acquisition is vulnerable to being unwound if the transaction is later called in for review and national security concerns are revealed. As you know, often insolvency sales need to be negotiated and executed within very tight timeframes. So having to deal with notifications under the NS&I Act can be incredibly challenging if not adequately picked up and built into the transaction timetable at an early stage. Additionally, given that some of the 17 sectors are broad, a significant number of insolvency sales could be caught by the mandatory notification regime. Whilst clearance may well be given in the vast majority of transactions, the timing issues cannot be eliminated. That said, the government has recently advised that the ISU, so that's the Investment Security Unit, that runs the approval process, can be contacted for views on whether the acquisition is notifiable. However, this will not amount to legal advice.
Right. And so picking up on that last point, what's the process and timing of notification? And can applications actually be expedited for distressed sales?
So that's an interesting and actually pertinent point, as the government issued market guidance earlier this year with respect to acquisitions where there is material financial distress, which then gives rise to a genuine urgency. For non-distressed sales, an online application process is to be used with submission of a form to the ISU, which sits within the Cabinet Office. The ISU has 30 working days commencing on the day of the application to review the transaction. This could result in the ISU either clearing the transaction or blocking the transaction or calling in the transaction for full assessments, which may ultimately result in the imposition of conditions if cleared. Given that insolvency sales often do not have the luxury of time, the new guidance acknowledging the need for potential expedition in the approval process is, in exceptional circumstances of material financial distress, is very much welcomed. That said, when looking at the guidance in detail, in order to benefit for the expedited process, detailed evidence will need to be submitted to the ISU. For example, the provision of 13-week cash flow statements, evidence of no support from funders, and confirmation of engagement of insolvency advisors. In practice, producing the potentially extensive information required to benefit from the expedited process adds significant burden at a time when there are often a number of competing pressures on businesses and may in reality not assist with very tight timetables. I'll be interested to see how this actually plays out over time.
Thanks, Sheena, for a canter through this topic. Certainly a topic to consider at the planning stage of all administration sales.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayer Brown audio programming, visit mayerbrown.com/podcasts. Thanks for listening.